So we want to start on sale and lease back. Sale and lease back. Sale and lease back. So allow me to share just a moment. I have shared something small there. Kindly go to the group. Check the group. So in the group, we are saying sell and lease back. So a lease back, actually sell and lease back, no, is normally shortened just as a lease back. So a lease back, notice there is a contract where the owner of the asset sells their asset and leases it back from the buyer. So the owner of the asset sells the asset, then leases back the same asset from the buyer. Benefits of a lease back to the seller. Now, in this case, the seller becomes the lessee because the seller, after selling, they lease it back. So the initial seller becomes the lessee and the buyer now becomes the lessor. So benefits of the lease back to the seller is capable of generating working capital. And that is the main advantage of a lease back. You have, let's say, you have gotten a tender to supply some goods, maybe to the county government. Your tender, itakupea pesa mzuri, like it will give you within 3 months, it will give you 7 million. You don't have that money, but you have a pickup which maybe you can sell at 3 million. And to service that tender, you need the 3 million. So you don't have 3 million, but you have the pickup. So you are required to be, you will be supplying them with cereals. Not even, with cereals. No, cereals, you'll be supplying them with fruits. Every morning you supply the county government with the fruits every morning. You reside in Nairobi, and these fruits you must deliver to the county government of Kiambu every 9 a.m. Those fruits must be there. And you have what you have is pickup, but you don't have the capital. So what will you do? The best way to raise that capital is to sell that pickup. Sell the pickup at 3 million so that you get that capital you required. Then you can talk to that buyer. You talk to the buyer that you can help me with this vehicle, the same vehicle. You can help me with this vehicle. I work with it. I'll be paying you 1,000 per day. Just an example. So if that is agreed, then you take back that asset. So you have the vehicle and also you have the money. That is called a lease back. And the main benefit of a lease back to the seller is to raise the working capital. So you give out the asset, you get the money, then now again you negotiate. So you have the asset, you will be, but mostly for business purposes. Don't get the asset back now just for fun. So for business, at least you generate some returns. Then within 2 years, you will buy another pickup. Then you can return even now that one to that person. So that's how a leaseback operates. So it's not something very bad. Actually, it's the best way of raising capital. All the risks and rewards of ownership may be transferred to the lessee at the end of the lease, in case of a finance lease. Yeah. So at the end of the lease period, we all know right now, in a finance lease, the title of ownership may be retained by the lessee. So he can use, as he pays the installment at the end of the lease term, again, he can remain with the asset. So remember, at first, he got the money, he got back the asset, he will be paying the rent, then upon the lease term, he may retain the asset. So those are major two benefits of a leaseback to the seller: generating working capital, and maybe the title of ownership may be retained. Benefits to the buyer. So the buyer now is the lessor. One, there is a guaranteed residual value upon termination. That is a general benefit of a finance lease. There is tax advantage. Since the interest from the lessee is tax allowable. When we are doing amortization here, we normally charge interest. So that interest which you charge is always tax allowable. We don't tax interest. So it's called tax shield. So that tax shield is a benefit. Then it reduces default risk. Since the lessee and the lessor had an initiated contract. When they sold at first, the initial sale, they entered into the contract. So they knew each other at that point. So when the seller is leasing it back, we don't even need a lot of formalities because we know each other better. At the point of the initial sale, we had a contract. So the default risk is very minimal because we know each other from the initial contract. Features, characteristics of a leaseback. So what are some of the features of a leaseback? One, there is a transfer of ownership to the lessee upon expiry of the lease term in case of a finance lease. So if it's a finance lease, the title of ownership may again remain with the initial owner of that asset. Then the seller becomes the lessee and the buyer becomes the lessor. So it is opposite of that other one. So here, whoever is selling now becomes again the lessee because they sell, then they get it back at the same time. So that is one characteristic of a leaseback, that the seller becomes the lessee and that the buyer becomes the lessor. The lease term constitutes a major part of the remaining economic life. That is a normal characteristic of any other lease. So now, those ones were some. What they're likely to ask you there are those benefits of a leaseback, characteristics, and what have you. So now, there's something I want you to write for me because I don't have them in notes, which is very important when you are dealing with a leaseback transaction. So write down there important notes. So let's call them important notes on a leaseback. That one we have to note down. So write important notes on a leaseback. Important notes on a leaseback. Then you say IFRS 16 in bracket leases, close the bracket. IFRS 16 in bracket leases, close the bracket, requires the selling entity in bracket lessee. Selling entity becomes the lessee. Requires the selling entity in bracket lessee to recognize a right of use. To recognize a right of use asset to recognize a right of use asset based on the proportion based on the proportion of the rights, based on the proportion of the right of use based on the proportion of the right of use retained, right of use retained on the carrying amount, right of use retained on the carrying amount of the assets, based on the carrying amount of the assets disposed of. Full stop. That thing is very, very important for us. Very, very important for us. So listen and listen carefully. The lessee, who is now the seller, you know, when they were selling initially, kuna kuwa na hiyo mchezo ya fair value na ile selling price too. Everyone wants to sell at a profit. And that one, you know, everyone wants to sell at a profit. Profit you will get at the amount over and above the carrying amount. So in the books, you know very well, the assets has a book value of 50. Where ukaenda ukauza at 80. So you are trying to get a profit in it, which is okay. It is business. But now, you sold at a profit, you sold at 80, then you are leasing it back. You know that person because you when leasing it back, you want whichever value is lower, which is the 50. Lakini wewe ulikuwa umeuzia at 80. You cannot sell to me at 80 yesterday in the evening. Then today you are telling me now, let me take it back at a price of 50. So who is saying what? So the right of use, because you know he has to recognize the right of use. The right of use is calculated as a percentage of the right retained. There is a right they retain because they normally play with the fair value and the sale price. The right retained on the proportion of the carrying amount. So the main question is, or the main concern is on you to know how to get that right of use, how do we calculate it, and recognize it in the financial statement. So right there, right of use. So this one applies only the lease back. So you say right of use, ROU. So right of use, you will calculate, it will be calculated by taking the percentage of the rights retained, times the carrying amount. Correct. So in a leaseback, the right of use is not straight like the other one. The other one, you know, you check the present value and fair value. But in a leaseback, you take the percentage of the right you initially retain, you multiply with the carrying amount of that asset. So the next question will be, how do you calculate the percentage of the rights which you are retaining? So percentage down there, percentage of the rights retained is equals to, so it is always a proportion of present value and the fair value. So you take the present value of the lease payments, present value of the lease payments, that is the installments. You divide by the fair value of the assets. Of the asset times 100%. Yes. So that's the only place you really need to know properly. Good. Good. Present value of the lease payment divided by fair value of the asset. So let's say if you do this, you get maybe 20%. So 20% is what this person had retained on that particular asset, because you know they played within the book value and the market value when they were selling. So it is always about what they will pay based on the fair value which they had sold that asset. So if you get 20% and the carrying amount initially was 50, take 20% of 50. That is what you should recognize, because you knew the book value of the asset. So instead of overstating, that is what you recognize. So you take the percentage you retain times the book value. That is the right of use. Full stop. Another hyphen. The lessee should also recognize. The lessee should also recognize profit or loss. The lessee should also recognize profit or loss on disposal. Profit on disposal. Profit or loss on disposal based on the rights of use. Based on the right of use transferred. Please underline transferred. Profit or loss based on the right of use transferred to the buyer. Right of use transferred to the buyer. Full stop. Full stop. So if percentage you retained was 20, it means the buyer you gave them at 80%. So profit is calculated on the rights which you have transferred. So how do you get the right transferred? Right transferred is 100% minus the right retained. That is how you get the right you are transferring. So there's no big deal there. That one I'm not even showing you how to calculate. The right you are transferring is 100% minus the right you have retained. So the profit, you don't recognize the entire profit. Remember, this asset is coming back to you. So you don't recognize the entire profit. You check the right you have transferred times now the entire profit. That is what you need to bring in the financial statement. Please allow me to take you to illustration. This is the kuna shallow end and deep end. So this is the deep end of leases in this stage. Section 3, I cannot even mention to them something like this. Hiyo watatoroka. But hapa hii deep end lazima. Ningetaka shallow tukiwatia pale tulikuwa. But this is the deep end. Now, the question which has ever been asked by the examiner in this class is this one here, the lease back. So you have to understand lease back properly. In 2021, there was a question. Let's meet there. December 2021, I think question 3 or something. If you get it, please tell us the page. December 2021. So that you can swim deep ends. You have to be strong. Who has gotten it and which page? I can see people are very. Hii class ni mzuri. Hakuna disturbance. Watoto wamelala. Everything is silent. Wengine pia ameshaambiwa kwa nyumba. Hii masomo yenu siwezani nayo. Siku utaitwa CPA Hilda. Hiyo ndio siku atajua hii masomo important. Who has gotten December 2021? To tell us the page. When there were 2 settings. There is pilot paper and the real setting. So I'm talking of the real setting. Yes, should be the real setting. In September. Minimum pattern. Question 3A. Hilda, page 42. So question 3A. Page 42. So I hope everyone is there. Allow me to read. It says, Harry Limited sold a building at its fair value of shillings 112 million to a finance company on 31st October 2020, when its carrying amount was 78.4 million. So they sold it at a profit. Tuanze hapo chini. Profit on disposal. Profit on disposal. Profit on disposal, they sold it at 112. Let's work in thousands. So they sold it at 112 minus 78,400. So how much is the profit on disposal? How much will the profit on disposal be? Profit on disposal, people are getting 33,600. Thank you. 33,600. That is the profit they made when they sold that asset. Let's continue. The building was leased back. Correct. So it is fitting in what we wanted. The building was leased back from the finance company for a 5-year period. For a 5-year period. So they leased it back for 5-year period. So they sold, then they talked with those people, bwana. Si hata wewe sometimes, unajua maisha kinaumananga saa zingine. Uko na Lexus, hapo na you are in need of money. Si unauzia mtu alafu ndio majirani wasione siku hizi hauna Lexus. Unaongea na huyo mtu siwache atakuwa na kupea something. But I don't encourage that if it is not generating commercial returns. So the building was leased back from the finance company for a 5-year period. The remaining economic useful life of the building was deemed to be 25 years. So it could be concluded that the control of the building had transferred to the finance company. Listen and listen carefully. In a lease, the lessee is only, if the asset is depreciable, depreciation is up to the end of the lease term, not useful life. Useful life, so when the lease term and the useful life are different, then to the lessee, the asset you only depreciate for the lease period. So like in this case, the lease term is 5 years. Useful life 25. 25 is not our concern. Our concern is only 5 years. So we go up to the end of the lease period. No problem. We continue. Lease rentals. So rentals are the 2 installments. So the lease rentals are 98.56, payable annually in arrears. Okay. The interest rate implicit in the lease is 7%. The present value of the annual lease payment was 43.20. So they have already discounted for you the 1 plus R minus, I don't know what's your story. So they have already discounted the 98.56, they have discounted, and they have gotten 4,320. The present value of the annual lease payment was 43.20. So at that stage, without moving on, I can get the percentage of the right they are retaining. That one I can get for a fact. So come here and say, percentage of rights retained, right? Retained. The formula is you take the present value, of lease payments, present value of lease payments, you divide by fair value of the assets. Times 100%. So the present value, they have said it is 43.20. So this is 43.20 divided by the fair value. Fair value was 112. So you divide by 112. Unajua unacheza na profit, alafu asset inakurudia. So there is that percentage we normally say you retain because you know the book value. Book value is equal to 78. So percentage of right return will be calculated that way. So tell me the percentage of the right you are retaining. Joy is getting 36% retention. So 36% retained. 36% retained. Meaning that percentage of rights transferred, so the right transferred will be 100 minus 36. So the right you are transferring is 64%. The right you have transferred is 64%. Na hii swali lazima mtaangalia properly. Next, we are continuing with the reading. Harry Limited, the last paragraph. Harry Limited recorded the cash proceeds. Waliuza pesa ngapi? 112. So that's what they recorded. De-recognized the building, and recorded a profit of disposal of 33.6 million in the statement of profit or loss. So they recognized the 33,600. No other accounting entries had been posted. Okay. Required. With reference to IFRS number 16 on leases and with suitable calculations, explain the accounting treatment of the above transaction in the financial statement of 8 marks. Now, kuna makosa nimeona. There's a mistake they did. They recognized a profit of 33.6 in the profit or loss. That is a mistake. You are not supposed to recognize the entire profit. Profit, you only recognize based on the rights transferred. Because you cannot lie to us, the asset is coming back. So, the right of retention, we have calculated at 36. So profit which you should recognize in the books should be on what the right you have transferred to the buyer. So down there, we are just doing calculations, we are collecting evidence. So down here you say, profit on disposal will be the right transferred times the entire profit, 33,600. That is what they are supposed to take, and that is what we are going to take in the financial statement. That is the profit we are going to recognize. So 64% of 33,600, what do you get? You get 21,504. 21,504. That is the profit we are going to recognize in the financial statement. Then, what is the value of the asset we are going to recognize? Value of the asset, the right of use, ROU. ROU is the right of use. The right of use asset. Maybe based on how we have been, I know this part of this is quite heavy kidogo, but I want to check whether we mnaelewa. It will be what times what? How will we get the right of use after lease back? It will be what times what? Let me check from your side. I know it's heavy, but you know you have to tell people the truth and they cry. So the truth is, this part of list they wanapenda advanced level. Unajua list iko 3, set 3 and set 5. So set 5 wanapewangwa the heavy part. So heavy part is this one here. But if I wanted just to make you happy, ningewacha tu huko ile ya kwanza. Museme list inakuanga nyepesi sana. Hapana, lazima tuende hivi. So people are telling me that the right of use will be 36% times 78,400. Joy, we must say 64. No, it is 36. So you take the rights you are retaining, the right retained. You know, right retained is coming back. You will use 64. 64 is the right which will be the lessor atakuwa nayo. 64 is on the other end. So 64 ungetumia in the books of the LSO. But now it has been leased back. You use the percentage retained. That's why you are saying people are saying 36. So right of use will be the right retained 36% times the carrying amount, the initial book value. So times 78,400. How much do you get? How much? 28 to 24. 28 to 4. Full stop. Correct. Now I want to come up with the journal entries. I want to come up with the journal entries at the start, at inception. When you pesa ililipwa nini. So right for me down there, journal entries. Unajua kuna makosa walifanya. They recognized, I don't know, the whole amount of profits. There are things they did which were not correct. So we have to pass journals at the inception, at the start, to see how they were, what they were supposed to do. So how we are journal entries. Journal entries. So journals at inception, let's be specific. So journal entries at inception. Journal entries at inception. So I will have here DR. We have reduced the thousands and CR. Hizi ndio maswali nawaambianga. Tusipofanya siku ya mtihani nakaa, mkifanya FR mimi nakaa mahali nashtuka. Akimungu wasilete ile list ya ile ya bring which is being brought back, the list back. Leta tu ya kawaida ikibidi. But once we do them, we are just comfortable. So let's go to what they did, the accounting entries which they did, so that we do the correct thing. Check the last paragraph of the question. Check the last paragraph. Henry Limited recorded the cash proceeds. So let's debit the cash book. So cash book, you will debit your cash book with the cash proceeds. Cash proceeds is the fair value, which is 112. So have there 112. Next, what again happened? They recognized the building. You know, when you are selling the asset, you need to credit the asset account because asset imetoka. Wacha itoke ndio irudi. Ikirudi, you recognize the right of use. But when it is leaving, you remove it from the financial statement. So to recognize the building, so you come here and say building at its carrying amount. So carrying amount. So you eliminate the book value of that building in your books. The book value was 78. So credit 78,400. So that you remove it from the financial statement. Then it is coming back. The same building is coming back. So when it comes back, you bring the right of use. Right of use assets. You bring back the right of use assets. So right of use is based on the percentage of retention, which is 28,224. So when the asset comes back, you debit it in the financial statement. So 28,224. Have that. That is done. Then two things remaining. At inception, waliuza kwanza. So when you are selling, credit the asset, bring the cash. Now it is coming back. On comeback, debit the right of use, recognize also the profits. So profits on disposal. Profit is a credit entry. So profit is based on the right transfer, the 64%. We got 21,544. So 21,504. That one you credit. You credit that one there. And finally, the lease liability. The lease liability. Lease liability is the present value here. They said present value of lease payments. You know, payment is what they will be paying over time. So they discounted and they got 4320. So that is the lease liability. In fact, this is what will amortize for your information, because this is the present value of lease payments. So you come here and say, and when you compare the two, it is the one which is lower. So this one here is what will be discounted. So you say lease liability, that is the last one, you credit 4320. You keep in a balance well. The general should balance. Can you confirm for me? This plus this, then add this side, because those are the only entries you're supposed to make at the inception. Can you confirm whether our journals are perfect? Yeah, they're okay. Then that is perfect. I don't know. At 142.24, so I don't know, examiner wanted us to go up to what extent of calculation. So where tunafanya, just allow me, because you know what they can do, they can bring this question, but now they restrict financial statements extracts. So we want us to go full blast. Full blast means unaenda paka balance sheet mwisho. That is when you have done everything. They did not give us the scope where to stop. So you stop at the end. End is balance sheets. So depreciation, annual depreciation, we are going to, sorry, again kidogo. Which values do we take here for depreciation and for how many years? So you tell me 30 for 3 years, what for these years? Which value here are we going to depreciate and for how many years? I just want to make us be in the loop. Which figure and for how many years? Josephat is saying, let's depreciate 224, no, sorry, 28 to 24 for 5 years. I agree with you. We depreciate, we depreciate the right of use, because that is now the comeback. So this is what we depreciate. Useful life, maybe someone came late. Useful life in the question is 25 years. Useful life is 25 years, but the lease term is 5 years. So for the lessee, in the books of the lessee, we depreciate the asset up to the end of the lease term, not useful life. So we'll go for 5 years, the way you are saying. So we'll take 28, give me the answer, 224 divided by 5 years. That is the depreciation which we'll charge. in the financial statements. So how much are we charging? How much are we charging? 5644.8. 5644.8. You know, when the question is open like that one, everything you are doing is marked. Kila kitu wana mark kama hii, wana mark, hivyo. Everything will be marked. You will find this thing is having like even 18 ticks. Then kama wanafunzi wameanguka wanasema any 8 ticks, mpatie those 8 marks. Watu wakipita hiyo swali sana, wanasema kama ni 18, any 16 and a half. So it will depend. So anything you do here will be marked because the question is open. They are not restricted. To that effect, I want to do amortization schedule. So let's check required. It is limiting for up to when, because trying to pick up 5 years. Let's check. Number one, the list started when? Check when the list started. When they list 31st October 2020. So 31st October 2020 is a financial year which is ending in 2021. So let's check required with reference to whatever and which suitable accounting treatment of the above transaction in the financial statements already for the year ended 31st October 2021. So they want us just to show for 1 year. So please, if it is 1 year, why should I bother doing amortization for the 5-year period? So if it is 1 year, then amortization you only do for 2 years. Why must you do 2? Because the second year will help you to get the non-current liability. I hope you know when we are doing amortization, it will help you to get the non-current liability ahead there. So when doing amortization, if you're not required to go up to the end, then the year under consideration unapita na moja to help you on the liability part. So let's carry out right there lease amortization schedule. Lease amortization schedule. Yes, I can do it there. So lease amortization. Your word schedule nimetoka nayo. So you just say lease amortization. Lease amortization. So in the lease amortization, I will have here year. So here is 2020, 2021. So I'll call it 2021. By extension, I'll go to 2022. I'll go to 2022. So I'll say here balance brought down. Balance brought down. Then this is arrears. So finance charge. Finance charge at 7%. 7% was the interest rate implicit. So that is what you consider. Then rental paid, balance carried down, and recognize an uncurrent liability and a current liability at the end. So have that arrangement. All right. So rental, you will be paying now the, let's see, 98.56. Check somewhere there, lease rentals in paragraph uko juu. Lease rentals are 98.56. I hope you can see it. 98.56. 98.56. And that. Then what you amortize is the liability. The liability. So which they discounted the present value. The liability, we got this one here. The lease liability, the 40,320. This one. This is what is subject to amortization. You amortize the lease so that because the liability is what we are going to settle. So this is 40,320. So let me help there. So 40,320 times 7%. I'm getting 22.4 plus 40,320 minus 98.56. So this is 33,286.4. 33,286.4 times 7%. You get 330.048 plus 33,286.4 minus 98.56. You get 25,760.448. Confirm that you have similar figures before we derive the liabilities. Kindly confirm for me. Yes, just what has confirmed. Allow others to finish. Remember, our concern is only in 2021. We are only doing 1 year. So let's go to the liability aspect. In 2021, and that's the only one we are doing, total liability is 33. Of 33, what will remain after 1 year is 25. So 25 comes to 2021 as long term. So you say here, 25,760.448. Then the difference between 33 and 25 is short term. So that one will be 33,286.4. You get 75.25. The state you might not be able to see, but I hope we are together. 25.952. 0.952. So complete that, please. For those who are not seeing, here we have 33,286.4. So long term is what will remain at the end of the next year. So end of next year, this will have not been paid. So this is what you bring up here. Then the difference, you take 33 minus 25, that one becomes short term. So 33 minus 25 is coming to 75, 25.952. From there, I can come up with the P&L, and it's only P&L for 1 year, balance sheet only 1 year. Hiyo kama tukifika pale, hii unafikia kwa mchezo unasema, huyu mwalimu ametuweza. Alitufunza jinsi ingine hapo ya kawaida alafu exam anaenda kitu mbaya. So, nataka any moment you are reading this, focus on this. I'm not sure, but I'm very sure, certain students never performed well in this question. And one of these 5 days inaweza buka kwenye, they will bring it back. Very good. So, Harry Limited, P&L extracts for the year ended 31st October 2021. They only want 2021. So, like that. So for the first time, you know, Harry is the lessee because they list back. But for the, you know, lessee, when we are doing extract our another income, we only give expenses, which even we know depreciation and finance charge. But for the first time, wanakuwa hapa na income. Because when they dispose of, they dispose at a profit. So you come here and say income. There was profit or gain. There was gain on disposal. Can you check? But I remember it was 21. It was 21 something. When we took the right to transfer, what did we get? 21 something there. We took the total 33,600 multiplied by the right transfer. 21,504. Yes. That is the gain on disposal which they need to recognize in the books. Then expenses are the two: depreciation, which we have up here, 5644.8. Then finance charge. Finance charge is this one here, the 22.4. Finished. You can add if you so wish to. So I hope you are done. I want to delete this section. All right. So allow me to delete. So write again, Harry Limited. So I'm not sure whether we were supposed to read here. So where would one to when you attack? But we have done it full blast. So statement of financial position, extract. As at 31st October 2021. Higher. Non-current assets, you bring the right of use. The right of use asset. Everybody remind me that figure? It was 28 something. It was 28. 224. 224. There. Less depreciation. So depreciation, we have it here. 5644.8. So you will get your net book value. You can get that. Then I bring the liabilities. So that is that. Liabilities. So liabilities, I'll go for the non-current and the current. It should be that one vizuri. Non-current lease obligation. Non-current lease obligation and current lease obligation. Yes, that is the correct wordings. Non-current lease obligation and current lease obligation. All are here. So 25, 760.448. This other one is 75, 25.952. Total is 33,286.4. So you can add. Usiseme kwa nini haibalance, it can't balance, there is no equity. So just ends there. To finish that, so the way I said, that is the farthest lease can go. And I should stop lease at that stage. However, there is a question I want us to do. Actually, lease should stop there. But we have not come across a question whereby we have not been given the present value, we have not been given the fair value by the examiner. So no fair value, no present value, but they just tell us the installments they will be paying. So we have not come across such kind of a question. And it is my wish that we check. Kuna swali niko nayo mahali. I want us to check where the fair value has not been given, present value has not been given. present value is what you compare with the fair value, then you take whichever is lower. So if those two are not given, how do you approach the question? So there's a question I got from somewhere. I want you to, nataka muiandike. You write it, it's not long. I'm sending in the group, then write it down. Once you're done, just write for me, text me they are done. We solve it then, tuachane na list until further notice. Further notice ni kwa mtihani. So check group and write for me this first. Once you're done, kindly allow me to know. Yeah, so I'll share with you that particular question. Can you write it in your books? Then you let me know when you're done. Then we can check on it. It's the last question on this, then we are done. We close that chapter. I'm here for once done, just text me your done.
Missing Coyote holding a woman in custody in connection with her husband's disappearance a week ago. Teresia Masese was taken from her residence in Ihango area of Tabala on Thursday, providing a statement regarding the disappearance of her spouse and its Russia.
Allow me to know whether you are done. Massive is done. Those facts, so I allow me to believe majority are done. If you are not done, then you will be done as we progress. So it says on 1st January 2019, Breakwood Limited entered into a contract to lease an item of plant and equipment from a supplier for a 3-year period. The terms of the lease were that Breakwood Limited was to pay shillings 500,000 each year, with the payment commencing on 31st December 2019. Initial direct cost incurred on the lease amounted to 30,000 and were paid for by Breakwood Limited. The plant and equipment had a remaining economic useful life of 5 years at the inception of the lease. The lease contract did not contain any purchase option for the lease, so maybe an operating lease. But as we said, in the new standard, there is no distinction. All of them, we treated them the same in the books of the lessee. Breakwood is lessee, they purchased from. Then Breakwood Limited can borrow at a rate of 10%, that is the implicit. Analyze the accounting treatment of the above transaction from the inception and for the 3-year period, of the lease contract. Oh, so lease contract 3 years, useful life 5. So we use 3. We don't go up to the 5th one. So in this case, we don't have the fair value. We have only been given the installments. So can you get the present value of those installments? So present value of lease payments, will be, it is 500 times 1 minus 1.1 negative 3 divided by 0.1. Give me that answer. So discount that. Discount for me that and give me the answer. Hilda, and just what there, 1243. 1243, 426. So fair value was not given. Ama wacha tuiandike tu casually, though not a must. Kwa mtihani usiandike, but for our revision tuandike tu casually. You say, since the fair value is not available, isn't available, comma, PV becomes the lease liability. So that is the one you will consider. But if the fair value was there, you compare the two, you go for whichever is lower. But now we only have the present value. Mwanafunzi mwingine mwenye hajakuja class, msifikiria ni rahisi ya search. Mtakuja class anachukua whoever is overthinking 500 times 3 years 1.5. Who does that? You have to discount to present value. So my point is, if not provided with the fair value, then you discount the installments up to the lease period. Then that one becomes the lease liability. Correct. So lease liability is 1243,426. That is what they need to pay. However, these people, Breakwood, they incurred a direct cost of 30,000, maybe kulipa lawyer and the rest. So direct cost is cost attributable to that particular. So to enter into the list, they have to incur 30. So that 30 must be capitalized. So you will earn direct costs. They have incurred 30. You know that is not part of the 1243. 1243 is the discounted what they will be paying. So therefore, the right of use assets, which we are going to recognize in the books, will be 1273,426. So you add the direct costs to that liability. But for amortization, we don't amortize this one here. We are not going to amortize the 1273. We amortize the 1243. Because what is amortization? You keep on, as when you pay, you reduce. But you see 30 has already been paid initially. So 30 has been paid. You don't amortize what has been paid. You amortize the outstanding. So outstanding is 1243. So in the amortization, we amortize the lease liability. You know, in those other questions, the liability, except the liability is the right of use. So, but that happens when there is nothing like this direct cost. So direct cost is paid upfront. So what remains is what you subject to amortization. Correct. Depreciation will be the right of use divided by 3 years. So how much will depreciation be? Depreciation goes up to the lease term. So how much will it be? Thank you. 42, 44. $25. Thank you. But walisema nini? Hebu go to required, please. Just check required kidogo. Analyze the accounting treatment of the above list transaction from inception and for the 3-year period. So ukiambiwa from inception unatupea tu journals. So journal entries at inception. Journal entries at inception. So at inception, I will debit the right of use. The right of use assets I will debit the right of use assets. So right of use, the 1273. So 1273 or 26. I will credit lease liability. I'll credit the lease liability. This one here, 1243. You know, we have already paid. So I will credit the cash book. Cash book, we have paid 30. So at inception, that should be the journal entries. Whichever corner watu watajaribu kuwafix hawatawapata. In least, hakuna kitu mnaweza letewa apart from hizo vitu. Mtakuwa na wao bumper to bumper. Hapa na pale. No escape for them. Ukirevise thoroughly. Sitaki kuona watu sasa hivi wamebeba encyclopedia kubwa ati tunasoma hakuna hiyo time. We don't have that time. You concentrate because like this now we have done 5 questions. If you understand those 5 properly, ukienda kwa mtihani out of kama ni marks ni 10, you list ya hiyo na 20 marks. Kama ni 10 marks, huwezi kosa kitu kama 6 ama 7. That is enough. So just have the concept. Out of those 5, you just have the concept in all of them. And all the 5 have different issues. So tumefika hapo. What do I do next? Let's go to amortization. Yeah, for those 3 years. So amortization schedule. Let's carry out amortization. So amortization, you amortize the liability. So amortization. So year, January 2019. So 2019, 20, 21. Yeah. Balance brought down. Finance charge at 10%. Rentals paid. So rentals. Balance carried down. Non-current liabilities. Current liabilities. Me nafika kwa amortization peke yake. The rest, after amortization, I know you can do the rest. The way I know you people now, extract is not an issue as far as I'm concerned. So amortization, you amortize the liability. 1243, 1243, 426. Remember, this is 500. So 10% will be 1243. Let me just round off. Yes. Nyinyi ni watu serious. Why I should not waste my time? Maybe I've already kicked you off. There's nothing you cannot do from there. Amortization, I know you are perfect. Just confirm for me if you are getting nil. Because we are rounding off to whole numbers, unaweza pata plus or minus 1. That is nil. Can you confirm? Just confirm for me that. The rest I know now you can do, even the extract. I'm very sure. Can you just tell me amortization? Round off to whole numbers, whether it's coming to 0. I'm a negative. If it's a small negative like -2, that can be due to rounding off. So that is 0. Come on, a big negative, walishalipa yote. So just finish for me the amortization. The rest, I have no problem. Who has heard those part is getting nil? 2 more confirmation. Confirmed by many. Thank you. Thank you. Okay, let me not put words on your mouth, but confirm for yourself. From there, because you know we need to move forward. Class in under part 9, so we have limited time. Confirm. 2 people can just confirm, so that we don't say I'm dictating. If I leave you with amortization, are you not able to come up with P&L and balance sheet? Is that not something you can do? So mnaweza fanya hiyo, because I need to move to something else now. But hata exam na kusema tufike huko, so we are just doing full yote extracts. Immaculate, huwezi fanya extracts? Linda, Patrick, Nancy, if I leave you at that stage, are you able to come up with the extracts? This being the 5th question. Yeah. And yeah, people are confirming. That is the spirit. So we are going to a new topic. What I just want you to confirm, do you need like 5 minutes break to refresh before the next topic? I'm go strong to the left. Just confirm for me that. Yeah, I'll give you 5 minutes break, but before break, in a ladies first, yes. So ladies, on your Google platform, tell me, IFRS 8 is talking about what? Then James, also Google and tell me, IPSAS for government, IPSAS 18 is about what? Because that is our topic, next topic. So, topic, IFRS number 8. For ladies, James, you check for me, IPSAS number 18. Just tell me what it says. IFRS 8 is on operating segments. How about IPSAS number 18? When you're talking about break ya haraka, IPSAS 18 is about what? For public sector. IPSAS 18. IPSAS 18, IPSAS 18. Even if you are a lady and you are in hali na uko nayo, unasema. lazima tungoje sana. You just say there's no problem. Just fact, IPSAS 18, segmental reporting. So that is where we are. Thank you. Operating segments. Na watu walitoka evening. These are some of the topics mlianza nayo, but just mkae tu. Ile mnasemanga refresher course. So just to be here, it's very important. It is 7:13. Let's meet back at exactly 7:20. So come back at 7:20. You can refresh. Mupange watoto mukimaliza ukimbie kanisa. So have the break. Now the break is over. Break is over. Is this person? This calling. Someone has just called. Just a minute. Alright, so now a small change kidogo, you will request you understand. Mwalimu FM anataka kutumia this link of ours for section 3 is getting some technical issues to log into section 3. So you want to use the same link. So what I want to do, I want to create another link. Lakini, what if? Oh, that won't work. Just a minute. Kidogo, don't. I just want to. There's section 3 we are going to class, and there's an issue. Kidogo, just hold on me. Meanwhile, let me share with you the notes mwanze kuangalia before as I schedule this class. I'll send you the notes, so just go through as I help them out.
Please try your data. Nambari iliyopiga inatumika kwa sasa. Tafadhali jaribu tena baadaye. Let's go. Laini zote zinatumika kwa sasa.